Hey everybody, thanks for joining us on our webinar where we talk about the Spartan Storage Debt Fund. My name's Ryan Gibson, the Chief Investment Officer with Spartan Investment Group. And today we're going to go into the details on the debt fund. Very similar to our private debt offerings, the debt fund offers our investors the opportunity to invest as a note investor, receive consistent monthly cash flow with no upside potential, but also the option to redeem, which we'll dive into on the webinar throughout the evening. So with that, we'll go ahead and get started. Hi, my name is Ryan Gibson with Spartan Investment Group, and tonight we're going to talk about the Spartan Storage Debt Fund webinar. But before we get started, I'd like to get our disclaimers out of the way. We're not offering any legal, tax, or investment advice. Everything we present tonight is just a projection, and please do all of your own due diligence on the offering, reviewing all offering documents and material. Consult your legal, tax, and investment advisor on any investment that you make. These are just projections and just a general overview tonight. So to review all offering documents, please read the PPM, thoroughly understand the subscription agreement, and go through all offering documents. So with that, we'll go ahead and get into the details. So this year we're offering 3 funds at Spartan: the debt fund, the income fund, and the growth fund. We have separate webinars on the growth and income funds that you can view on our YouTube channel or on the investor portal. But tonight we're going to talk about the debt fund. And so we're going to dive into those details. The debt fund really provides 3 main things: cash flow, monthly distributions, and it's backed by our self-storage investments. And our target returns are quite simple. You're either going to be a Class A note investor and you're going to receive 8% per annum paid monthly. And this is going to have a 90-day lock-up period, meaning that your investment has to be locked up for 90 days before it becomes redeemable. If you want to just let the investment accumulate interest and keep that cash flow going, you can stay in for as long as 5 years, but you have to be in the investment for a minimum of 90 days before you request a redemption. The other option, and the only other option, is the Class B note investor, which pays a 9% per annum rate of return. Distributions are monthly as well, and that is a 2-year lockup period, meaning that you have to have the investment minimally placed with Spartan Storage Debt Fund for 2 years before you can make a redemption request. After 2 years, it's the same 90-day redemption request time frame, and that note also goes 5 years before it ends its term. But if you've never invested in private lending, this is a great time to be a private lender. In fact, Jonathan Grays, CEO of Blackstone, recently in a LinkedIn video said it's a great time to be a private lender because there's a lot of inefficiencies in the market right now, and some of the benefits really are fundamentally strong in investing, that you get predictable monthly cash flow. You get a shorter timeline for repayment. In this case, equity investments usually have a 5-year or maybe even a 6-year time horizon. This, on the Class A note, is an 8% per annum return that you can redeem within 90 days of the investment. So it's a shorter timeline for repayment. And for those self-directed IRA investors or using their retirement accounts, we welcome self-directed retirement accounts, but there's no UBTI or UDFI when you invest in private debt notes. So let's talk about where we are in the market. This is the Chatham Financial forecast of the SOFR rate. So this is essentially kind of modeling what interest rates are going to be over the next several years. And you can see in 2023, our interest rates the Fed funds rate is expected to go up, and likewise all other rates like SOFR and Prime, etc., are expected to continue to increase throughout 2023. And so you may notice that CD rates or high yield saving accounts, there's a really great opportunity to make interest on cash that's just sitting in your account. But what I'd like to point out is that it may be good today, but in the future, the analysts are projecting that interest rates are going to really decline and bottom out over the next couple of years, later part of 2024, early part of 2025. So if you're looking to lock in some great interest rate, the debt fund is an opportunity to do that. And it's worth noting that, right now, you might want to think twice about holding cash or cash equivalents this year, because the yield is supposed to start to decline like I said earlier, at 2024, 2025. And so a yield above 4.5% cash on cash is a really great vehicle right now to invest in, and the private debt really provides that opportunity. And so some of the analysts are predicting if the Fed were to follow the playbook that they have in mind, investors over the next 5 years would be better off locking in a better yield today for the long term. Here's some other noteworthy things on yields and the expectations of them falling over the next couple of years. We can see, again, another prediction of the federal funds rate going down quite significantly after 2023, which is all going to kind of tie into what interest-bearing or T-bills will pay investors over the next several years. And you can see it kind of bottoming out again, end of 2024, early 2025. So just to kind of reiterate, we have two share classes, or two note classes, I should say, for the investors in the debt fund. And one is the Class A share. It has a 90-day lockup minimum. All of our investing in the debt fund is a $50,000 minimum, and that pays an 8% per annum return. So if you were to invest $50,000, that would be $333. That is paid out on the first of every month in the debt fund. If you were to do a Class B note, that is a 2-year lockup minimum with a $50,000 minimum investment, and that pays out 9% per annum, or about $375 a month if you invested $50,000. Both of these notes are a 5-year term, but the notes have a differential, again, in that lockup period when you can potentially call the money back. And I'd like to say, for complete redemption language, please reference the PPM to learn about redemption, first come, first serve, and the availability of redemption. So what do we use the private debt for? Why does Spartan go out and raise this private debt? And there's a couple of things that we do, and I'd break them into two things. Initial improvements on properties and, of course, the facility purchase. Those are kind of the two things, kind of improvements, capital expenditures, and the purchase of properties. And we're not going to use more than 65% leverage with the private debt, so we're not going to be over-leveraging properties, et cetera. And we're going to use that money to basically buy and finance new properties in this interesting interest rate environment. And we're going to be using the funds to improve properties like you see up on the screen. And then also we use the funds to do things like buy and acquire investments. So for example, this would be a great featured project where we build a property from the ground up, and we might use the private debt fund to fund the construction because it's more efficient. We can get the money faster. We don't have to rely on a bank loan that might take 6 to 12 months to do for ground up construction, which we've historically seen. And we can get to work and get the property built more efficiently with the private debt. We also can be more efficient with draws on using private debt, and really it helps our equity portfolio perform a lot better. So some of the things that we've done in the past, we've had over 7 full cycle private debt repayments on different projects. We've done over $40 million in private debt in the past, 30 million fully repaid, 10 performing throughout our portfolio, 10 million performing today. These are some of the examples of projects that we've raised private debt for and then successfully either refinanced out or eventually just sold or paid off the debt entirely on the asset. A little bit about who the borrowers are. The principals at Spartan, Scott Lewis, our CEO, Ryan Gibson, that's myself, the Chief Investment Officer, and then Ben Lapidus, our CFO. And $100 million net worth across the borrowers and over $3 million in liquidity. And so that's just a little bit about who's at the helm of the investment and who's taking on the debt for this opportunity. We still will do monthly reporting for the debt investors. You'll get monthly updates on the investment, really specifically to the fund, kind of a quick summary of what's going on inside the fund, what moves the fund is making. And you'll also get financials for the investment. And I wanted to kind of highlight the fact that the debt fund doesn't have any fees paid to the sponsor. So we're not collecting any monthly asset management fee for the debt fund. We're not doing any expense reimbursement. We're simply putting the debt on our assets and completely passing on 100% of the profits to the investors. So if you look at other debt funds, they might charge 2 or 1.5 to run the debt fund. I think what's really unique about our debt fund is that we're not charging any fees. So but we'll report out any financials, any monthly distributions. Obviously, there's not a whole lot of inconsistency here. You're going to get a flat 8% or a flat 9%. There's really going to be no variability in distributions. And 1099 INTs as a debt investor is what you receive in your tax documents. Those get sent in January of the following tax year. So if you invested in 2023, you're going to get an INT in 2024 by no later than the end of January for your investment. So how does it work? Well, so to sign up, really investors are going to sign the subscription agreement for the Spartan Storage Debt Fund. And then the investors are provided a promissory note, either the 8% note with the 90-day lockup or the 9% note with the 2-year lockup. And after you get the promissory note and everything gets signed, the investors fund. The following month, you'll start your interest payments and your distributions will begin. And that's really the process. So these are the 3 funds that we're offering this year. QR code on the screen will take you to our wait list. We haven't opened up our funds yet. We were planning on opening all of our funds on March 15th of 2023, so in about 2 weeks from the air date of this webinar. And if you wanted more information about the funds, jump on our wait list. That's the way that you can be first to know when they actually open for funding, and you can get your funding secured. And as always, funds are accepted on a first come, first served basis. So we only have $60 million to raise in the debt fund, and then we're going to close it off. So again, if you want to invest, that is it's based on first come, first serve. Any questions that you have about the debt fund, you can email us at investors@spartan-investors.com. We can get all of your questions answered. But I wanted to thank you tonight for watching the Spartan Storage Debt Fund webinar, and we look forward to working with you. Thank you.